In this video, we're going to talk about absorption costing, which is also known as the full cost method of accounting. And when we talk about full costs or absorption costs, what are we really referring to? Well, if you think about a manufacturing firm and determining the product cost for a manufacturing firm, you've got it broken down into a few things. Remember the direct materials, I'll just abbreviate that DM, and then we've got direct labor costs, and then we also have overhead, right? And overhead can be broken up into a couple different costs. We can think about variable overhead, right? Variable, it varies with the amount of production that we have, and then we have fixed overhead, which I'll just abbreviate FOH, right? So really we've got this direct material, direct labor, and then these two types of overhead, and we can use those to calculate product costs. But when we think about absorption costing, what we're basically saying is when we go to calculate our unit product cost, and what we're talking about product cost, we're saying like our cost per unit. Let's say we produce 1,000 units, and we're saying, okay, how much of these costs do we attach to each product? Well, if we're going to attach all these costs ultimately to the product, then we're going to call that the full cost method. That's what absorption costing is. And you might be saying, well, hey, wait a minute, all these costs are incurred regardless. What are you talking about? Of course we're going to recognize these costs. Well, if you remember, we also had this notion of period costs, right? Things like SG&A. So a period cost is just going to be expenses incurred. It's not attached to the product in the sense that it doesn't go to inventory, right? Remember, manufacturing firms, we have these product costs. They're also known as inventoriable costs in the sense that these costs will get attached to the product and flow through as inventory and then ultimately flow out through cost of goods sold. Now, let me just back up a moment here. So when we think about all these costs and attaching all those costs, that's absorption costing, right? Now, you might be saying, well, how do we even have an alternative? What are we talking about? Of course, when we put together an income statement or we do something like that, we're going to be using absorption costing, right? Well, there's this other thing called variable costing, and let me just here. I'll put maybe I didn't organize this the best. So we'll say we've got absorption costing here. So with absorption costing, when we think about the product cost, we're going to have the direct materials, the direct labor. Let me just scroll down and give it a little bit of space there. Variable overhead and the fixed overhead are all going to attach to the product, right? But when we do this other method that's called variable costing, when we think, and I'm not just talking about variable costs, we're actually talking about an entire different method here, variable costing method, as opposed to the absorption costing method. With variable costing, so let me just, maybe this will make it a little easier. With absorption costing, when we have these things here, all of them are going to be treated as product costs, right? So these are all going to be product costs. But with variable costing method, we're actually only going to look at direct materials, direct labor, and variable overhead as product costs. So you might be wondering, well, what happens to fixed overhead? How do we deal with this under variable costing? Well, basically we treat it as a period cost, just like SG&A. And you might be wondering, well, how does any of this matter? What is the point? Aren't we just basically rearranging cards in the same deck of cards? So let me just jump into an example, and I think it'll make it a little easier to understand, because the way that we treat this fixed overhead, whether we include it as a product cost under absorption costing or whether we just expense it as a period cost under variable costing, this is going to have very important effects on how managers interpret information and how profitable our firm looks on a quarter-to-quarter or year-over-year basis. So let's jump into an example, and let's say that we have a company that makes hot air balloons, right? So we make hot air balloons. We sell them for $80,000 each. That's our sales price. I hope that's not cut off there at the side of the screen. And let me just scroll over a bit so you can see that a little better. So we're going to sell, let's say, and we're going to use absorption costing. Let's just forget about variable costing method for the moment. We use absorption costing, and in quarter one, Q1 here. That's just the first quarter of our year making hot air balloons. We're going to sell 10 hot air balloons, and we're going to make 10. What I mean by make is, we're going to actually produce 10 hot air balloons, but we're going to sell 10 of them in quarter one. Now, quarter two, it's important to note, we're going to sell the exact same number of hot air balloons. We're going to sell 10 again, right? So from a sales perspective, basically quarter one and quarter two are the same. But we're actually going to make 20, right? We're going to make 20. So then we're going to have 10 left over for a future period, something like that. So we're basically going to build a little inventory. So when we think about how this would shake out, when we think about our cost structure, when we think on a per unit basis, we're going to need to know some numbers before we can even think about putting together an income statement or knowing the unit product cost or any of those different types of things. Before we can know our profitability and stuff, right? Really, right now, we just know we sold 10, we made 10. Now we need to get into the nitty-gritty and say, okay, what is that, the direct materials and these other numbers. Now remember, when we're computing the unit product cost under absorption costing, all these costs are going to be ultimately attached to the product, right? So this direct materials is $25,000 per unit, right? So we're talking about per hot air balloon, right? That's the unit. So for each hot air balloon, let's say it takes $25,000 to make that. So I'm just going to we'll put the $25,000 right here. Now, again, we're not building the income statement yet. We're just looking at the product cost per unit. We just want to get an idea, when we go to make this income statement, what should be the per unit product cost of a hot air balloon. And it's going to be different for quarter one and quarter two, and you'll see why in a few moments. But for the direct materials, that hasn't changed, right? We're just assuming that when we think about these variable costs, that they're going to be the same in each quarter. So it's going to be $25,000 in each quarter. That means quarter one, quarter two, when we go to make a hot air balloon, is $25,000 in direct materials for each hot air balloon. $10,000 in direct labor, and this is really simple where I'm coming up with these numbers. I was taking it right from here, and then now we're gonna have that $2,000 of variable overhead per unit. And again, I'm just gonna transfer that number. They're just going like that, right? So the fixed overhead is different, right? Because we don't have a per unit yet. Off the bat, we just know per quarter. So we just know in each quarter, we're going to incur $60,000 in fixed overhead. So how do we deal with that? How do we get that? How do we convert that to a per unit basis? Well, we can think, okay, how many units did we make in each quarter, right? And well, we've got that up here. We make 10 hot air balloons in quarter one, and we make 20 in quarter two. So let's look at quarter one right now. We made 10, and then we've got $60,000 in fixed overhead. So we just take that $60,000, write it right here, $60,000, divide that by 10, and that's going to give us $6,000. You say, well, why are we dividing by units? Why are we doing it? Well, because we're looking at the product cost per unit, right? So we just take that $60,000 and divide it by the number of units that we made. Now, for quarter two, it's going to be the same deal. We've got $60,000 in overhead again, and we need to attach that to the product, right? We need to attach that to the hot air balloons that we're making. We made 20 of them, right? So now we're going to take, and it's going to be a little harder to break this out. So let me just write down here 60,000 divided by 20. Apologize for my penmanship, and that's going to give us 3,000 per unit. So all I did was just take that fixed cost for each quarter. It's 60,000 fixed overhead, divided it by 20, because that's how many hot air balloons we made in quarter two. And then, so when we think about our product cost per unit, we're going to have that 3,000 there. So I hope you can see all that there. Let me just scroll a little bit more, make sure it's clear. And so now we can start thinking about putting together our income statement, or well, actually, let me sum up what our product costs are, and that'll make it a little easier for you. Let me just erase this real well. Instead of bringing out the eraser, I'll bring out that. So let me sum this up. So for quarter one, when we think of our product cost per unit, we're thinking about $43,000 All that is, I just added these together. There's nothing fancy. And then here we've got 40,000. Now you might be saying, okay, hey, look, really nothing changed about our cost structure over quarter one to quarter two, but we have now a different product cost per unit. That's kind of weird. Well, really, we're just spreading this fixed overhead. We're spreading it over a different number of units, right? There were more units in quarter two that we produced. So this fixed overhead of 60 grand got spread out over a larger number of units, meaning it's a smaller number per unit, right? So now we can finally start thinking about how we would put together our income statement, our absorption costing income statement here. And for quarter one, now again, this 800,000 in sales, all it is we said that we had a sales price per balloon of $80,000. And we sold 10 balloons in each quarter, right? So just 10 times 80,000, that's what gives us the 800,000 in each quarter. Remember, the sales were the same. Nothing changed about our sales. Now, with the cost of goods sold, you might be wondering, well, how did this come about? Well, remember, when you sell a unit, right, that's when something goes from inventory to cost of goods sold. So in each case, our sales was 10 hot air balloons per quarter, right? So how do we figure what the cost of goods sold is? Well, we just calculated the per unit product cost, right? That's up here. We just calculated that for each quarter. Now, it was slightly different because of that fixed overhead, but we've got some numbers. So for quarter one, it was that 43,000, right? We multiply that by 10. That's the number of units that we sold and that are flowing through to cost of goods sold, right? So 10 times 43,000 is going to give us 430,000. That's our cost of goods sold for quarter one. Quarter two, same principle. We say what was that product cost per unit that we calculated for quarter two? It was 40,000. We multiply that by 10, which is the amount of hot air balloons that we sold that are flowing through cost of goods sold. 10 times 40,000 is 400,000. So that's our cost of goods sold for quarter two. Now we can go and kind of look at our profitability a bit and say, let's look at the gross margin for each quarter now. Now we look and we say, hey, the gross margin, right, that for quarter two is actually higher than it is for quarter one. We've got 400,000 in terms of our profitability for quarter two and versus 370,000 for quarter one. Now, of course, there are other things we could consider, right? SG&A and those types of things. We could get into that. Now, we're not going to, just for simplicity, let's just focus on the gross margin. It looks like if you had no other information, you would say quarter two was a better quarter than quarter one because we had more gross margin, right? But wait a minute. Let's take a step back. Let's remember something, that we sold the same number of units in quarter two as we did in quarter one. We didn't have any boost to sales or anything like that, right? So it's not a better quarter from that perspective. Okay, well then you say, hey, well maybe our costs went down. Maybe it got cheaper for us to buy materials to make hot air balloons. But no, it didn't, because remember, we assumed that direct material cost per unit, we just assumed that was going to remain constant for quarter one, quarter two. All the variable costs, all those things are going to remain constant. So now you might be thinking, well, hey, what the heck is going on here? Well, let's take a look. Let's break down our cost of goods sold. So let me just change colors here. So when we think about what is going into that cost of goods sold, we're going to have the direct materials, the direct labor, the variable overhead, and then the fixed overhead. All right? So now for quarter one, or for both quarters, we think, okay, direct materials is 250,000. Right? 250,000. For direct labor, it was 100,000. And then for variable overhead, it was 20,000 in each quarter. None of that changed. What changed? Fixed overhead changed. We had 60,000 in quarter one and 30,000 in quarter two. Now you might say, well, hey, the costs were different, therefore the profitability should be different. But remember, this fixed overhead was the same in each quarter. All that happened is, because we made more units in quarter two, that fixed overhead for that quarter just got spread, all right? It got spread over a larger number of units, right? The fixed overhead was $60,000 in each quarter. That didn't change. Nothing changed about our costs just because the way that we're attaching the costs, right? We had some inventory buildup in quarter two. Remember? We made 20 hot air balloons in quarter two, but we only sold 10. So we built up some inventory. So some of that fixed overhead per quarter is now sitting in our inventory. So basically, we could take away a really important principle when we're thinking about absorption costing. We can say that under absorption costing, if our production, and by what I mean is the number of units we produce, if production is greater than our sales, then basically that means we're gonna increase our inventory, and that's going to end up deferring. This defers some fixed overhead. Some of that fixed overhead is going to be put into inventory. It's going to be capitalized, and we're not dealing with it right now. And now you might be saying, well, hey, what about that variable costing method? What's up with that? Well, we're going to talk about that in a future video, but suffice it to say right now that fixed overhead, remember we said that's treated as a period cost under the variable costing method, right? That's the difference. This is the difference right here, that fixed overhead, how that's treated versus variable method or absorption costing, right? Variable, we're just going to say, hey, we're taking this as a period cost, no matter how much it is, no matter how many units we produced, we're just going to expense it as incurred, similar to SG&A. And therefore, we're not going to have kind of these distortions that are going to fool us into thinking that one quarter is better than the other, when in reality, nothing changed. We think about this. Nothing changed with the number of sales. Sales, so we'll just say sales didn't change from quarter one to quarter two. Cost structure didn't change. And that's very important. Yet, in spite of these things, cost structure didn't change, sales didn't change, the profitability changed under absorption costing. And you could see where that would lead to problems, right? Because, like, for one, it's going to make one period seem artificially better even when these things didn't change, right? Quarter two wasn't any better than quarter one. Now, also, this can kind of give managers an incentive to produce more units in order to lower costs. So just think about it. If we come back and we say, okay, well, our product cost per unit was lower in quarter two. It was $3,000 as opposed to $6,000, simply because we produced more hot air balloons. Well, what if you doubled and said, well, okay, instead of producing 20 hot air balloons, let's produce 40, and then that'll get this fixed overhead per unit even lower, right? And what does that mean when you reduce the product cost per unit? That's going to increase the profitability. The gross margin is going to look higher and higher. But that's not necessarily good for the firm because you're building up this inventory that might later go obsolete. But you're giving people with this absorption costing, you're giving them perverse incentives, right, where they can defer some of that fixed overhead simply by producing more units. And so it looks more efficient, right? It looks more profitable. It looks more, but it's actually harming your firm. And it can make it really hard to kind of interpret things. Like, remember, we talked about CVP analysis, cost, volume, profit. And so, that's going to predict. We're saying, okay, well, with this target, net income, how do we reach this target profit? How many units do we need to make? And all that can be kind of messed up, too, when we start having these inventory buildups or changes in inventories under absorption costing. But with the variable cost method, we don't have any of those issues with CVP. But just in general, it's important to remember that kind of we're distorting things with absorption costing. We can really get a distorted picture because of the way we're treating that fixed overhead cost. And you might ultimately be wondering, well, why are people even using absorption costing? What is the advantage of absorption costing if there are all these problems with it? And the reason is that people use it because it's basically seen as being required for external reporting purposes. So basically people think, okay, for internal purposes, we might use variable costing method. For external purposes, everybody pretty much uses the absorption costing method. So we're going to use it when we actually put together our external financial statements. This is what auditors will accept and so forth. So it's kind of the conventional method for external reporting, and that's why the absorption costing continues to exist in spite of these disadvantages.